Welcome back to CFI, Credit Finance and Investing, and in today's video we're going to talk about 401k investing. So in case you don't know already, what is a 401k? A 401k is a tax vehicle that allows you to invest for retirement, and in the standard 401k model you get a tax deduction, meaning you don't have to count the income that you put in the 401k towards your taxable income for that year, assuming you meet the income thresholds. And in the Roth 401k model, you do not get a tax deduction. However, the benefit to the Roth is at retirement, any of your initial contributions and all of the earnings are able to be deducted tax-free. There's some other fine points that we can talk about at some future video, or your financial advisor can provide you with that information, but for all intents and purposes, those are the main differences. Now, who has a 401k? Well, 401ks unfortunately are generally limited to employees of companies, and it's mostly for larger companies. Some small ones have them, but generally the larger companies offer 401ks to their employees. Self-employed individuals are out of luck. However, there are some other mechanisms that self-employed people can use to save for retirement. Now, there's two different types of 401ks, as I mentioned before. There's your standard 401k and there's your Roth 401k. Generally, the people that would choose the Roth 401k are people who think that at retirement they will be in a higher tax bracket than they are when they're in their earning years. The standard 401k would generally be for people who think they will be in a lower tax bracket in retirement. And that honestly is the majority of people in the country that are retiring, at least today. That could change, and it would depend on your financial goals and your situation. The majority of people are still contributing to a standard 401k, to my best knowledge. Now, why invest within a 401k? There's pros and cons. The money is locked up when you put it into the 401k. If you deduct it or if you pull your money out at some point, generally there will be a hit of 10%, a penalty, in addition to the taxes that you would pay on that. Now, why is that a bad thing? Well, if you need the money for other investments, or if you want to put the money towards something else, you lose 10% of your money in addition to the taxes. However, it's also a good thing because it prevents most people from pulling their money out, so that they are almost mandated to save it for retirement. There's a shortage of retirement savings in the United States right now, so any encouragement people can have to save that money is not generally a bad thing. One of the other pieces that I mentioned earlier is the deductions are tax deductible. So money that you put in is then deducted from your income, and with tax strategy planning, you may be able to drop yourself into a lower tax bracket or avoid going into a higher tax bracket depending on your income. The big advantage, in my opinion, to 401k savings is the employer match. Many employers will match a portion of the 401k contributions. And in fact, if we look here, let me turn my screen on, many employers will match up to 50 cents on the dollar, up to 6% of your salary. So if you put 1% of your salary in, your employer would put 50 cents on the dollar. So for every dollar you put in, you would get 50 cents. That is a 50% return on the money you put in. A very good return, and over time, as we get into that, we'll talk more about how that plays into your investing. Now, some of the fine print, yes, it is tax deductible. That can be a great thing, but remember that's only for the non-Roth version of the 401k. And something else that's very important to remember, especially in today's world where job hopping is more prevalent, is there's typically a vesting period. In the instances that I've seen or I've been involved in, it's typically between 2 to 5 years that the match for your employer will not become yours. It will not become your investment for a period of up to 2 to 5 years. After that, any contributions they put in are your investment. And the reason they do that is they want you to stick around. They're putting an investment into you. They're not only are they training you in the company, but they're literally putting money into your retirement fund, and they're hoping that you'll stay with the company long enough to make that investment pay off for both them and you. So let's hop into a 401k calculator and show you the importance of starting young. The younger you can start, the more likely you are to have a very successful retirement. This is a retirement calculator from a website called NerdWallet, and you have to put in certain assumptions. So let me walk you through the assumptions I've put in, and we can show you how that plays out in your favor. So this anticipates someone starting at 20 years old. I can't stress enough how important it is to start early, to start young, and the younger you do, the better you will be off. So we start at 20 years old with an average income of $36,712. Now, how did I come up with that weird number? Well, I came in and looked at the average salary of different age groups, and the average salary range in the United States for 20 to 24-year-olds is $36,712. Keep in mind that averages out people that are living in California or in large metropolitan areas, which generally has higher salaries, with people who are maybe living in rural areas and don't quite have that much. Something that's interesting, of course, you'll notice that the age group between 25 to 34, the salary pops up significantly to $52,156. So it doesn't anticipate you staying at a $36,000 salary for long. And this, of course, going back to the calculator, anticipates a starting balance of zero. Most 20-year-olds don't have a 401k that they've been saving in previous. Now, some other basic assumptions. I'm assuming that people will be contributing 10% of their salary with a 50% employer match. Some employers will pay more, some will pay less. There is a cap most of the time on the amount your employers will pay, and in this case we just put it at 6% because that's kind of what we've seen as a going average, and a retirement age of 65. Now, as a side note, most people are anticipating retirement, or most financial planners anticipate people retiring at about 67 now, because that's about when Social Security kicks in, and that number could change too. The average rate of return that we're putting into this calculator is 8%. Now, let me give you some more background on that. Why are we choosing 8%? Well, 8% is kind of a relatively safe number. We could go lower or higher, but we're using the S&P 500, which is the 500 largest companies traded on the stock market, and their average return over time. I pulled up a calculator that shows the different periods and the average rate of return for the S&P 500, and if you look at 5 years, it's fairly significant, 15.36%. If you go out to 30 years, it goes to 9.67%. You'll notice there's some volatility in here also, with the 25-year model showing a 7.18% return and 20 years at 9. Now, why is that? Well, the S&P 500, just like any other stocks, and as it is an aggregation of stocks, it goes up and down, way up and sometimes way down. You can see in the 1970s it was way down, and then back here in the later 70s it popped up again. I personally have been investing in certain markets, including the .com crash, and this is about when I got my first 401k, was here in the 1996 range, actually the 1998 range. And when investing, I saw the bottom fall out of the market, and you can see here it went down as much as 21.97% during that time frame. And I do remember it was a conscious decision and a scary decision to leave money in that, but it's a good thing we did, because not only did we invest here and we lost some value, but we invested when the assets were down, and down significantly, which means here, when you can see in about 2001, 2002, when the market came back, we benefited from the gain also. Similarly, in this 2008 time frame, you can see the market went down. You probably can't see that number, but it's down 36.55%. That was a very scary time to be invested in the market. However, if you stuck through it, the market popped back, and all of those assets that you bought during that downtime were a significant gain, and all of the assets that had decreased in value regained their value. Now, every person that's involved in the market will tell you past performance is not it's not an indicator or not indicative of future gains, but it is generally understood that over time the market will increase in value as long as you have the time to gain. So that's why we're talking to younger people today. If you're in your 50s, 60s, or maybe even late 40s, you may want to take a more conservative approach. Back to the calculator. So you'll see on this calculator, it starts with now. It has three different types of earnings here. The first one is your contributions. The second one is the employer match. The third one is the investment returns. And you'll see that the contributions from the time someone is 20 years old to 65 years old, the contributions only equal $260,000. The employer match equals $130,000, and that's $130,000 of essentially free money. However, the investment return is $2.6 million. And if you look at the balance based on these factors over here, at the end of 35 years, you have $2.97 million in your 401k to retire. That should generate a fairly significant return and have a very comfortable retirement at that time. You'll notice, though, that as you go through here, the balance doesn't go up that fast until about 2046. And that's when it really takes off with compound interest. And compound interest is an amazing feature where you're getting interest on top of interest on top of interest, and you can see it really accelerates your returns. Now, why start young? Well, let's take this and let's say that person who's 20 years old today decides not to invest in their 401k and they want to wait till they're 30. They go from $2.97 million down to $1.26 million. About $1.6 million less because they took 10 years off on their investments. So that is why it's so critical to start young, stick with it, and don't go away and don't pull the money out. Now, there's some other factors here. For example, if someone says, well, I don't need $2.7 million, maybe I'll retire at 60 or 59. Well, you still have almost $2 million if you started young and you're able to do that. The other factor, of course, is the rate of return. You have different options within your 401k generally. Now, a lot of companies will not allow for stock to go in the 401k. Some may. Generally, I have not seen specific stocks. Usually there's some investing options that include, they have mutual funds, they have index funds, sometimes they have targeted funds that say, well, I'm 20 now and I want to retire at 65. And so you have different options, and they're rated by risk, generally low, medium, high type of risk. They may have different rating systems, but they all equate to about the same. And what you need to do is determine your level of risk. Are you going to be okay if your portfolio loses 30% in a 2-month period? I've seen it happen. It's scary. And if you're not comfortable with that level of risk, then you would want to choose a medium or a low risk type investment. If you are comfortable with higher risk, and a lot of times people in their younger years are encouraged to take higher risk because they have more time to make up for it, and they have more time to retire or to invest through market cycles. So you need to determine your risk level and then invest accordingly. The other thing to look at when you're choosing investments is what is the long-term return of those investments. That's one, and they'll usually have a graph or it's something that tells you their 5-year, 10-year rate of return, and sometimes they'll even tell you longer than that. But they'll also show you their expense ratios. And that becomes important because your return is the market return less the expense ratio. So if an investment has a 10% long-term rate of return and a 3% expense ratio, you have a 7% net rate of return. And if a different investment has a 10% rate of return and a 1% expense ratio, that then becomes a 9% rate of return, which over the course of time makes a big difference. Let's look at that. So let's play with the rate of return here. We have it currently plugged in at 8. Let's say we drop that down to 6, to 6. You'll see that 2.97 million becomes 1.64 million just with a 2% long-term rate of return. Let's take this up now to 10%, and the 2.97 million becomes 5.66 million. So these little adjustments, these little differences have lasting impacts on the overall balance that you'll be able to get. So with 401k investing, the most important thing is to start young and stick with it. Even if you leave your employer and go to a different employer, you can take your 401k balance and roll it over to the new employer, or you can roll it into an IRA and manage it yourself, at which point you can then invest in stocks. And if you can educate yourself on stock market investing, that can be a very good option. So retirement planning doesn't seem to be something glamorous. A lot of times it's not something that people in their 20s want to think about. But the earlier you can start, the more comfortable you can be in retirement. And it doesn't mean you can't take other vacations or trips or do other things you want to while you're young. It just means that you need to keep a long-term view, plan for the future, and have a very comfortable retirement. Thanks for being here. Hope you have a great day. Also, if this video was of value to you, please feel free to leave a comment below, like and subscribe, or share with others. Thank you.